Hello and welcome to Your Finance TV. Today we're sitting down with Gary Brode and Mark Rossano to talk about the Fed and what they did and what they've done after this week's rate decision. Is contagion just going to be limited to US banks, or could the demise of Credit Suisse just be the tip of the iceberg? And last, we look at the possibility of other industries and companies that could have made the same mistakes that Silicon Valley bankers made. Gary, Mark, welcome to the show.
Thanks, Tux.
It's a pleasure to be back. Thank you.
Before we jump into the questions and getting all this great information from you guys, don't forget to click on that little subscribe button below to stay up to date all the news that's coming through from Your Finance TV. All right. Now that we've seen the Fed decision, Powell has had his speech, Yellen has put her clear comments out there. What next? The Fed can't do both, either address inflation or help the banking system. What is their mandate? Are they there for the people or for the financial system? They're between a rock and a hard place here and can't really do both. What is their next step? I'll let either one of you jump on this one.
Mark, you mind if I take this one first?
Oh, sure, please.
So, Dux, to me, the part of all of this that I find the most humorous are all of these asset managers who are really just asset gatherers who have made a fortune over the last decade with interest rates at zero. It's been great for blowing up an asset bubble. It's been great for the people who are just gathering assets and putting them to work. But these people don't seem to understand that the Fed is hiking rates, and that's going to affect equity valuations. And they have the option to reduce exposure or short something. And they're somehow acting like they can't do that. And what we see on Twitter and in the media are these desperate pleas to Powell to stop ruining the finance system and to actually, to lower rates, and, the Fed is going to break something. Here's the issue with all of that. Everything that's broken was broken by more than a decade of zero or near zero rates. The only thing that's happening right now is by the Fed going to more normal rates. And by the way, being at 5% isn't strange from any kind of historical point of view. All it's doing is exposing what's already dead, or mostly dead, if you like a line from The Princess Bride. And so what we have are all these people clamoring for lower rates. They want their own personal bailout, but these are people who are professional asset managers. They should be able to do something about it. Powell has been explicitly clear since the second quarter of last year that his intention was to raise rates to get inflation under control. And after every meeting, he comes out and he says this, and he's talked very clearly about higher for longer. We are going to raise, and people don't seem to be able to adjust to that for reasons I don't completely understand, other than blind hope. Again, reduce exposure or short something. They have options. And so, what we're seeing is a Fed that's been actually crystal clear about what their mission is, what their intentions are, and a market that doesn't seem to believe them and hasn't for the last year.
And I just want to highlight, I think it's great that you said the clear comments from Yellen, because that was a classic Yellen flip-flop where she said, "Oh no, we're not going to do that." And then she saw that Powell came out and said that there was going to be support for deposits, and she completely changed her tune. So I thought that was quite amusing. Now, one of the key pieces, so to break it into two different parts. So on the Yellen side, they're trying to put together some form of backstop, and there's the discussion of a $2 trillion fund that would be that would live at the Fed, that would essentially start with $500 billion and then quickly be able to escalate to $2 trillion to backstop. I agree with everything Gary had pointed out. There's no reason why people should have been surprised by rates going up. And I think Powell, to your point, is what do you address? And realistically, I think the inflation piece is the biggest component of it, but it's also really difficult to address the inflation side when in the last 2 weeks, they've put $400 billion back into the market. So they've essentially undone in 2 weeks, essentially almost 9 months, 10 months of quantitative tightening. So you almost have two sides of this, where they're putting money in, but they're still raising rates. And so they're trying to do both. But the problem is the $400 billion going back in, just adding liquidity, is going to push inflation up higher. And to Gary's point, is trying to bring down those asset prices and manage asset prices. The biggest component that we have to look at when you're looking at this, and just simplifying it into asset prices and wages. When you have an asset bubble, now you either have to have wages that are going to go up and risk a wage spiral, or you're going to have to bring those asset prices down and bring them back into balance. And at this point, I think the bigger detriment that could happen would be a wage price spiral. And that's something that it's better off going in, bringing down asset prices. And the only way you can really do that in a meaningful way is by raising rates, which I think 5.5, 5 3/4 is where they should be. This might scare them a bit and slow them down. But if you look at other types of metrics, they should be much higher. So I think this is kind of what they're looking at. And then some of the components, and we'll talk about this probably a little bit later as well. There's this view, because to Gary's point, Powell's been very clear, we are raising rates. And everybody in the market's like, no, you're not. You're gonna cut. You, Jeremy, you're playing with us. And it's like, guys, he has been very, very clear, and he has done exactly what he said he was going to do. But even now in the market, you have this view that he is going to cut, and it's I think the most recent one has it where he's cutting by June.
I keep seeing this thing on Twitter where people keep putting out those charts that show you what market expectations are for rates, and people saying, they're expecting rates to come down. And I'm looking at that thinking, the market, the bond market, the futures market there has been wrong about this for a year. And people are saying, look, the bond market is expecting rates to come down. But that exact measure has been consistently wrong for a year. By the way, Mark is completely right. We've got the everything Fed here. They're raising rates, quantitative tightening, 300, 400 billion of quantitative easing at the same time. These guys are basically asking the banks if they want more liquidity, which is the equivalent of asking second graders if they want more candy. Like these guys are trying to cover everything. And regarding Janet Yellen, we put out a piece every week called 5 Things to Know in the Market this week. Our suggestion for Tuesday's piece was that we give Janet Yellen a hot dog stand, let her manage that. And when she shows she can handle that one, we'll move her up to something that, demonstrates a little more trust in her. But why anybody is trusting these people right now is completely beyond me. Everybody just failed in the exact same way that they failed in 2008. The regulators failed. Yellen failed, the Moody's, the sell side, the bank executives, the depositors, the venture capitalists, every single person who failed in 2008 just failed in the exact same way. And if that doesn't shake people's confidence in any of this, I don't know what will, and why people are saying, oh, well, we just need more regulation. No, these people have no idea what they're doing. Again, start with a hot dog stand. We'll move our way up.
I don't want to pick on hot dog vendors because they do some great work, but
she can aspire to that.
All right. Well, this actually leads pretty well into this next question as well, because the market is very jittery, but it hasn't sold off aggressively. There's still fear in the regional banks, and we could speculate same could be said for some European banks. We've seen Credit Suisse, and we're recording this on Friday, the 24th. And Deutsche Bank, there's speculation around on them as well. Are other countries susceptible to what is happening in the US banks right now?
So I'll take this one first. So the answer is yes, the contagion is real. There is a very good chance that this spreads. And I think it's funny with Credit Suisse, because I think Credit Suisse I think this was their 7th bailout since 2008. So I think by the 3rd or 4th bailout, you should probably figure out you're really not that good at your job, and you should probably not exist anymore. So I think that was just a matter of time. We saw it in 08, we saw it in 11, 14, again with the Glencore in 16, 18. So to see them on the wrong side of it, I think it's a problem. But Gary brought up the point on ZIRP, or zero interest rate policy, which was really introduced by Alan Greenspan back in 1987 with the idea that if you bring down rates for a long period of time, you would you would essentially soften the downside of the credits of the business cycle, and you would put higher increases, and then you would eventually create this ability to grow. But again, that ignores hurdle rates, that ignores, clearly what people like to do with free money. So when you look at ZIRP and you look at the liquidity side, you all of a sudden had this massive push into commercial and industrial loans, commercial real estate loans. You had residential real estate loans, and all of these loans, the hurdle rates kept going lower and lower and lower, to a point where these people were investing in things that only worked at 1.5%, with the idea that, oh, well, it's never going to go up. And then all of a sudden, what happened, as Gary highlighted, he was very clear about it, rates started to go up. And now all of a sudden you had Brookfield that defaulted on $1.9 billion in loans. Now, but you had Blackstone defaulting on 513 million euro loans. So when you start looking at how these regional banks and how these banks have played, I mean, you're looking at, in Europe, they had negative rates. So when you're looking at how they were churning this money, and that was, a lot of these were used in solar farms, they were used in all of these different areas, and everyone did the same thing. And that's the whole problem, is because if I do it, then Gary's like, well, Mark's doing it, so I have to compete against Mark. Therefore, I'm going to undercut him by a quarter point. And then I see Gary taking my clients. It's like, oh, no, he's going a quarter point lower. I'll go half a point lower. I mean, this was how the London whale was created. This was where all of a sudden you're competing against each other, and you're just increasing risk. Now, that's one side of it. The other side of it is what the bank should have been doing, which was their hedging portfolio with their deposits. And instead, because of where rates were, they went down and they played the duration game. They were buying 10-year paper, 20-year, 30-year paper. And when rates started to go up, and all of a sudden you had this inversion, what they should have done is like, all right, we need to shorten our duration to make sure that we have the capacity. We're going to get some of that additional interest. And when they mature, we'll be able to mature that quicker, and then roll that into the rates that are, grinding higher. So at least we'll make back some of this and create some sort of buffer, if you will, between the two. None of which happened.
Well, it's the common sense trade, that side of it, isn't it? It's I'm still scratching my head over this. Gary, you've obviously got some thoughts on this. Sweating on the talk.
I do, and I love the last point Mark was just making. Because somebody asked me the same question 2 weeks ago. I said, how does this happen? How do you have a bank that doesn't actually understand bond duration risk? And here's the thing. I don't know. I have no idea what was going on internally. I don't even know that the people in the bank knew what was going on internally. But I'm just going to make 2 points. And people have this sense that, well, it's a large organization. Shouldn't somebody have been on it? Don't these things work? No, large organizations just tend to be ridiculously dysfunctional. And just think about 2 people. First of all, the way you get to be president of a bank is not by being a great bond trader, or by being a great risk manager, or by being a great portfolio manager. You get to be president of a bank by being great at sales, by having lots of great relationships, in this case, with venture capitalists who will bring you business. You get that job by bringing in business. And then, this is a TV program. It's going to have wide distribution. I want to be careful how I approach this. The best I can say is that the person who was supposed to be in charge of risk management seemed to be focused on issues of a deeply personal nature. And it seems, based on the stories I've heard, on everything I'm reading, that the person who was supposed to be evaluating risk wasn't even looking at it. It wasn't really part of her portfolio of things that she was focused on. And, if you don't have anybody doing it, then nobody's doing it. And these large organizations tend to build momentum. Part of that happens because of consensus, right? You get in a conference room and 20 people are talking. Nobody wants to be the odd person out. And so you end up with these ridiculous outcomes. And, I think the same thing is probably happening at a lot of financial institutions. And again, I'm going to go back to the point I made before, which is everybody failed in the exact same way that they did in 2008. In 2008, the banks had no idea what their exposure was to the CDSs. They had no idea. In this case, they had duration risk. I don't know that anybody's tracking this or thinking about it.
And I think
sorry.
Sorry, go ahead.
No, go ahead.
No, I was gonna say, and you bring up a lot of good points, and the problem, all of these banks, and to his point of, the sales side, everyone has to be competitive. So everybody now has a credit card. Everybody, regional banks always did a lot of consumer loans on different things, not that, but they auto loans, obviously mortgages, second mortgages. So when you look at the exposure, and then as asset prices start to fall, and people are running with these crazy credit card bills, I think if you blend Gen Z and millennials, it's like $9,000 in credit card debt. And when you see credit card rates, ARPs going from APRs going from 12% to 24% in a matter of 8 months, all of a sudden you get bad debt expenses, and bad debt expenses start to grow. And then you have to withhold some of this capital from going into the market and writing new loans that would help at higher rates, that would help offset some of the ones that you had done or that are going to be non-performing at this point. And the problem is, because you bring up the point about European banks and we can go into Asian banks, everybody was playing the same game, and it was all about real estate. We've seen it now in China when you look at what happened there. And to Gary's point, it's like, what were they doing? Like, you're literally watching the second largest economy in the world implode on a building perspective, with all of this shadow money flying all over the place, buildings half built, not getting finished. And you think that rates going up and a global slowdown is not going to do something similar. And I think everybody was caught flat-footed in clearly not looking in the right place at the right time to manage their risk.
Yeah, we're seeing this in a lot of places, but Mark, you're right. China is the number one spot for, you have a real estate bubble, a pricing bubble that's being blown up by 0% rates, or something close to that. And people could see worldwide inflation numbers going up. You had to figure that the exact thing that you were using as collateral on your loans was going to go down in value as interest rates went up. And again, this is not particularly sophisticated financial analysis. It might be the kind of thing that the average person doesn't think about, when they're sitting down at the dinner table. But if you're a risk manager at a bank, this is the kind of thing that should be second nature. It would have been the kind of thing that you would have covered in your 20s or even in college, to understand that there's an inverse relationship between bond yields and pricing, and that will play its way out in the exact same way in terms of mortgage payments or collateralized loan payments. So the same thing will happen in the real estate market. And I think the rest of the world is facing the exact same problems the United States is, and in many cases farther ahead. Mark and I have spoken at length about the issues Japan is facing. He just talked about China. They've got a huge real estate problem. The UK came 15 minutes away from a pension disaster just a few months ago. And the EU is basically where the US and the Federal Reserve are, only they're further down the road. And the US is getting away with ridiculous policies here simply by being the best house in a bad block. Right? We're benefiting from the fact that everyone else is doing the same dumb, stupid things that we're doing. They're just doing them harder and faster.
So listen, we've broken down like Silicon Valley Bank's mistakes and some of the other smaller banks as well. But are we naive to think that these are the only companies that are making these mistakes? Are there corporates out there that have made similar mistakes but haven't been disclosed yet?
I think you have to assume that's the case. That's always the case too. There were some unique circumstances surrounding Silicon Valley Bank, right? I mean, they did have really a one industry customer. They had an incredible amount of deposit concentration, both in terms of the number of depositors and also the fact that it was all one industry. As we talked about or just alluded to earlier, maybe more than most banks, Silicon Valley was focused on non-financial issues. And that's going to hurt. The old expression is, you find out who's swimming naked when the tide goes out. Well, the tide went out pretty hard, but they had a year to prepare and spent the last year not doing it. So I think there were some specific things going on at Silicon Valley, but those same issues, that same malfeasance or just lack of care, again, it's the same stuff we saw in 2008. I think you have to assume there are other institutions out there that to a greater or lesser extent are going to be facing the same problems.
And to that point, if you just going back to 08, and if you can go back to the savings and loans crisis and all these other some things where, if history doesn't repeat itself, it rhymes. And if you look at it from the perspective of 08, you had Bear Stearns, and then there was another 6 months before we actually started to see additional stress. And there was that bridge where you had some extremes, and then you started to sniff out, okay, well, who else is in this weird position that they have unsecured deposits or, deposits that are above the FDIC limit and this big loan book. And I think the problem is going to be, it's going to take time, but as rates don't get cut, as stress grows abroad, because one of the other things that happened, which is always fun when you look at, to Gary's point on the Fed trying to do everything, they reopened the international US dollar swap lines. And that just enables countries that may be running short on dollars to access it through the swap line instead of coming through the market itself to address their liquidity, which I think caught some people by surprise, because when they opened it, nothing really happened. And then all of a sudden there was a massive spike. And that says, okay, well, why are you doing that? And I had an interesting seat where from 06 through 08, I was trading in the money markets on the overnight desk. And you saw all of a sudden this panic of, in the overnight market, 600 billion be going into over $1 trillion. And everyone keeps talking about we need more liquidity. It's like, well, there's over $2 trillion in the RRP fund. Like, why are we not pulling that out? Why are we not looking at this in a meaningful way to use that liquidity to backstop some of this and redirect? Now, I think one of the key points that you also asked is on the corporate side. And I think that's really important, because when you look at zombie companies, for those that don't know, a zombie company is something that doesn't make enough money to support itself. It has to rely on the bond market and additional investments in order to keep the lights on. And you had to Gary's point on VCs and what they were doing in this, there was less and less due diligence being done. There was less risk management being done. So no one really cared or showed any meaningful care on when they were going to be cash flow positive. Because realistically, after 18 or 24 months, if you're a company that is going commercial, you should be standing on your own 2 feet. Not saying that you're not going to have expansion capital, but you should have a cash flow backdrop that's going to support yourself. So I think the biggest thing now on the corporate side, as these rates essentially make it where they can't keep funneling it, where every time they have to roll that debt to a new bond or a new loan, it's at a higher and higher interest rate. I think that is going to be, let's say, the straw that's going to break the camel's back on the other banks, because now you have, we know what they did at SVB. We know their exposure. How many people are exposed to Uber or Lyft or Food Dash or something that has a very high burn rate but very low cash flow or no cash flow, and it's just a zombie company that's just feeding off of cheap debt?
It's whilst it doesn't remind me of 08, it's 08-ish, right? We have that first incident that happens. And then maybe the shoe to drop is going to be in 6 months when some of these stories start coming out, like the examples you've put. And all of a sudden, a company that's like got a $2, $3, $4 billion market cap in the space of like a week is like, they're in trouble and no one's there to bail them out.
Right. I mean, you saw it with Carvana. I mean, Carvana went and just because they needed the feeding of cheap debt, you needed the feed of cheap auto loans, you needed, and those obviously auto prices went to the moon, but now as that reverses and auto prices are coming down to a degree, but you have these rates exploding, now you what's your saving grace? Like, what value are you providing, and why myself coming in a bankruptcy or restructuring, what value are you bringing at this leverage ratio that I should keep alive?
Yeah, I look at there's a company called Automotive Equity Exchange, and they track the car lease prices. They're a Dublin-based company, and yesterday I saw a post in LinkedIn on showing the drop in price of Teslas. I can't remember what model it was, but it's a massive drop off. Like, that's the examples of different things coming through. I'm not implying that Tesla's going to disappear overnight. They're hopefully they're better positioned than most, but those are the examples of that Carvana example is a great example. And I think we're going to see more and more of that. All right, gentlemen, listen, I want to say thank you both so much for your time. Before we sign off, Gary Brode, tell the viewers where they can see you.
Oh, thanks. Deep Knowledge Investing. If you just go to www.deepknowledgeinvesting.com, plenty of information there. The research tab is the blog, lots of information. And Gary_Brode, Brode on Twitter.
Okay. Yep.
Oh, sure. So, and then for myself, my website is C6. That's the letter C, number 6, capitalholdings.com, where I have a private equity fund in energy infrastructure and energy transition. And then we have our Twitter at MarkFNY. And then we have our podcast YouTube channel at Primary Vision Network.
Fantastic. Gentlemen, thank you so much for your time today. Very insightful, and we look forward to having you back soon.
Thanks, Doug.
Thank you. Appreciate it.
And for everyone else out there, good luck investing.